Hi everyone, in this video we are going to see about how to minimize investment risk due to geopolitical events. Geopolitical tensions from border conflicts to global wars can send shock waves through the stock markets. But as an Indian investor, how do you manage and minimize those risks without panicking or pulling out at the wrong time? In this video, we will break it down. What are geopolitical risks? Geopolitical risks refers to events like war, terrorism, political instability, or diplomatic conflicts. These events can disrupt global supply chains, cause oil price spikes, currency fluctuation, and impact investor sentiments, often lead to short-term volatility. How Indian markets reacted in the past? In the Indian context, markets have historically reacted to geopolitical shocks, but the volatility has been short lived. For instance, in the Kargil War, which happened in 1999, Nifty fell by around 8.3% but recovered within months. In the Uri surgical strike, which happened in 2016, there was a minor blip, then there was a strong rebound. In the Russia-Ukraine war, which happened in 2022, which is still going on till now, which caused global impacts, but Indian markets outperformed peers later. Here we are going to discuss about the 5 effective strategies to minimize risk during geopolitical events. Let's now look at the 5 effective practical strategies you can use to reduce the impact of geopolitical shocks on your investments. The first one is diversification across asset classes. Diversifying your portfolio is the first line of defense. A well-structured mix of equity, fixed income, gold, and even international funds helps reduce dependency on any single market or asset class. The second point is about allocate to defensive sectors. In times of uncertainty, sectors such as FMCG, healthcare, and utilities tend to remain stable due to consistent demand. Allocating a portion to this can bring down your portfolio volatility. Third point, we are going to see about gold as a strategic hedge. Gold historically acts as a safe haven asset. A 5 to 10% allocation can offer valuable downside protection when your equity markets are under pressure. The fourth point is about maintaining adequate liquidity. Keeping 6 to 12% of expenses in liquid assets ensures that you are not forced to exit long-term investments during emergency. It also provides a peace of mind. The fifth point is about stick to asset allocation and rebalance periodically. When markets move sharply, rebalance your portfolio to maintain the planned allocation. This often means buying low and selling high automatically. Mistakes to avoid during geopolitical volatility. Just as important as knowing what to do is knowing what to avoid. Here are 4 common mistakes that hurt investors during geopolitical uncertainty. Panic selling in the market dip. Market dips are uncomfortable, but reacting emotionally can turn temporary losses into permanent damage. History shows that markets do recover. Timing that recovery is almost impossible. The second point is about making decisions based on headlines. News cycles amplify fear, but investment success comes from discipline, not reaction. Focus on long-term fundamentals, not daily headlines. The third point, it is about drastic asset shifts, all in or all out. Large but sudden shifts in asset allocation increases the risk of locking in losses or missing a recovery. Stay aligned with your financial plan and risk profile. The fourth point is about the ignoring the big picture. In a moment of uncertainty feels overwhelming, but your financial plan is built for the long haul. Avoid letting temporary events derail your long-term objectives. Geopolitical events will come and go, but your portfolio is for the long run. The right strategy, diversification, and discipline, and staying informed, you can weather any storm without derailing your goals.